Alrighty, so in this video I'm going to do a bit of top-down analysis. A lot of people have been asking me, what do I do? How do I start from a high time frame and work my way down? And in this video I'm going to try and break that up into segments, talk about the importance of each of the time frames, how relevant they might be to my trading strategy, and how you can implement this for yourself. So let's get into it. Again, if you've got any questions, feel free to ask me, but that's all good. So just starting on the daily time frame in terms of what's happened throughout the week, we've created new highs, right? We've created all-time highs. Like this is the previous high here. If you have a look, and we've swept that. That high was created, in about July. So we've swept the all-time high. But more recently, look where we were delivering from. So a good way to use the high time frame is when you actually move into a higher time frame PDRA. So when we move down into this bullish fair value gap, you then want to mark out the halfway point or the consequent encroachment. And when you start working with big, high time frame PDRAs, you want to start marking out different quarters. It's not the quarterly theory, but essentially you grab your Fibonacci and you mark out this fair value gap, right? And all you really need, you don't need that or that. You just need the 0.25, the 0.5, and the 0.75. And what you're looking at, or what you're trying to see, and I'm just going to reverse this just so it's a bit more clear. You just want to see where price stops, right? Is price digging? Are the bodies closing below the 0.5 level, or are they kind of respecting that level? Notice here how the bodies, the wicks, don't even touch the 0.5 level. We try once on this day, right? We try again on this day. Next 2 days, we essentially find support here, and then we breach to the upside. So what that tells me, as soon as we struggle once, twice, 3 times, and then the next day we start to displace higher, that tells me that this is probably the next draw on liquidity, which is this swing high. So in terms of the daily time frame, how important is it for my style of trading? It's not that important, because if I'm taking trades on an intraday basis and the average trade length is about 30 minutes, the daily time frame for me just gives me an idea of where I think price is going to go. And does that change how I trade? Not usually. So the daily time frame doesn't have too much weight in terms of my trading style. But if you were trading on a larger time frame, if you're trading using the 1 hourly or a higher time frame, then yes, 100%, the daily chart would be really important to you. But let's leave that there, and then let's go to the 4-hour time frame, right? So you can see here that price retraced down, right? I'm going to get rid of this now too. By retracing down, we swept this swing low, right? So we swept sell-side liquidity. And this is from a few weeks ago, right? So sell-side liquidity was rated, and we'll go all the way until like yesterday, which is Friday. So we rated sell-side liquidity. Now, what I'd be looking for as soon as price takes it out, and when's it take it out here at 10 o'clock on Monday, which is the AM session, I'd be looking, how do we react into the afternoon and into the next couple of days? Do we displace past this low and dig way further into this gap, or do we just displace slightly and then move back to the upside? If you said the second one, you would be correct, because notice here, it's just the wick that takes that out. We try again, but then notice, and I'm going to mark this out for you too, if I use my Fibonacci on this candle's wick, right, and I'm just going to get the 0.5 level up, treat wicks as fair value gaps. So we come down, we sweep sell side, slight little retracement, we come down again, look how perfectly the bodies respect consequent encroachment of that wick. Treat wicks as fair value gaps. It's technically like a rejection block, is what ICD calls it. So we bounce off it once. This second time that we come down, all that we're doing here is coming down into these 3 candles. These 3 candles are an order block, the last 3 candles before a shift up. But you could also treat it like use this wick again, because again, a fair value gap can be revisited twice. It happens all the time. And you could get up, say, the 0.25 and the 0.75 levels. And what I'm going to do again, I'm just going to draw this in the opposite direction so it's a bit more clear. And notice the second time we actually revisit, we barely come past the 0.25 level, which is great. That's showing, you could call it an unwillingness to go any lower. So at this point here, when you've got the market trading down here, you could be saying to yourself, okay, well, it doesn't really want to go any lower, especially when you have displacement here, right? Where does it want to go to next? It wants to go to this swing high, right? So when you're reading price action, this is how the 4-hour and the 1-hour and the daily and the 15-minute work. It's all the same. Like you could chart similar things out on a smaller time frame. If I go now to the 1-hour time frame, right? Let me look at price action. This here, this small move down was just to raid sell side. and then we start the buy side of the program. So this is when smart money starts buying, and we start to reverse to the upside because we've just taken that sell side and we've tapped into a daily or higher time frame 4-hour fair value gap, and now it's starting to progressively move to the upside, right? So let's say, for example, you want to look at a particular session, right? You see this reaction to the upside here, and this is on the 1-hour time frame, right? You can see this time frame here. Look, that's 11, that's 10 o'clock. If I mark out these swing highs, and you could do this yourself too, like if I mark out any of these swing highs, these would now be targets, because the fact that we've rated the sell side, we tried once to come lower, we tried twice to come lower, but we've displaced higher each time. That tells me that the market's in a buy model program and that we want to go higher. So does that mean that I'm only going to look for buys? No. You can still look for sells even if the market on a higher time frame is bullish. But if you can get your trades to line up with a higher time frame analysis, often they're going to move smoother and you can probably hold them for longer. But again, it just depends on your trading style, because me personally, I'm holding the trade for maybe 30 minutes, sometimes 15, sometimes 10, depending on how aggressively it moves. So for me, I don't need to hold it for 3 hours or 4 hours. So it might be slightly different based on your trading style. For me, what I find holds the most weight is the 15-minute time frame. Right, the 15-minute time frame holds the most weight. So that's the first time we tried. The second time we tried, then we displaced high, creating a new high, and we came back down here. When we come back down here, that's at 8:30. So that's a news day, right, or a news event. But when we come back down here, for example, all price is doing is continuing the buy program. And if I grab my Fibonacci from this swing low to that swing high, and I'm going to change the settings here so you can see, if you're in a buy program, as seen in the charts, have a look at this. If I get these levels out, notice how price comes up into a level of premium, comes back down below 0.5 into a level of discount. Then we come back up and down, come back up and down. So even if you're in a buy program, notice how like you could take advantage of these sell moves, these sell moves, these sell moves, these sell moves. And then really we work into the last 2 days of price action, which I think are kind of good to talk about the last couple of days. This, right, if you're watching price and it's done this, it's continually stepped up, it's stepped up, it's stepped up, it's stepped up, and you see this here. What does that look like to you? Just those two levels, because we know the market likes to target relative equal highs. So you can see what I've done here. I've gone from a high time frame to get the overall order flow, which is bullish, and then you go to a lower time frame to see what the market's doing. And the time frame that I use 90% of the time to mark out fair value gaps and whatnot, 90% of the time is the 15-minute chart. Sometimes it could be the 4-hour, sometimes it could be the 1-hour. It just depends what's closer. So what I mean by that is if I see these equal highs happen and form, this session, right, we just place lower. We come back up, we just place lower. What I'm looking at now is I'm looking at this price leg on the 15. I'm drawing my Fibonacci in that whole price leg. And as we're heading lower, because I know the market wants to move from discount to premium, I'm looking for any PD arrays that sit below the 0.5 level that price could react off. Now, these two down close candles are an order block, but notice how only a fraction of it sits below 0.5. It's not in my attention, but what is in my attention is this bullish fair value gap, because it's only partially being traded into, right? And it's within a level of discount, right, below the 0.5 level. So I'll be marking this out, right? I'll be marking that gap out here. And what I'll be doing with that gap is then I'll be using my Fibonacci on that gap. So I'll be measuring my Fibonacci on that fair value gap. And what I'll be asking myself is, how do we trade in that gap? Do the bodies close below the 0.5 level or do they not? And you can see here it's just a wick, a slight wick, and then we immediately displace to the upside. Now, how this can be seen in essence is this is all accumulation. So this is where you put all the concepts together. You see all this accumulation here. I honestly thought that we'd take those relative highs here. I thought that, right? And I was wrong at that point. So as soon as we started to displace lower, in my mind, I think, okay, later on, we're going to take these relative equal highs, because you can't leave highs like that. They're too clean and the market's drawn to equal highs and equal lows. It's like a magnet. Think of it like a magnet. Accumulation period here, right? Staying in a tight little range. You can see this as a big manipulation on like a larger time frame. and this is the redistribution now, the distribution back to buy side targets, right? So by moving to the downside, notice how on the 15-minute you can get a lot of things from this. Like that's an order block, that's also a swing low. So I take out that swing low, right? So we raid sell side liquidity, We tap into a fair value gap, we respect consequent encroachment, we displace back to the upside, and this is the PM session, right? 2 o'clock to 3 o'clock. Let's get that on our chart. So let's go now into the PM session. Let's go right here. Let's go to the 1 minute time frame. So you can wait till these PD rays get tagged, right? You can see that's that swing low, right? We sweep that. There's accumulation here, right? The power of three again playing out. We've got accumulation here. We've got an abrupt move down into a PD array that sits in a level of discount, which you can see there. What I'd be anticipating now is I'd be anticipating a move up to minimum the top of that accumulation, but ideally we want it to go higher, right? And what you could do here is you could use your Fibonacci again. This whole leg, right? If I grab my Fibonacci from that high to this low, this is where you can apply the standard deviation tool to get your projections, right? So all you need is the 2 to 2.5. 2 to 2.5, what rests within 2 to 2.5? Well, I'm assuming on a higher time frame there's a fair value gap there. Let's confirm that. Yep, beautiful. So we know between 2 and 2.5 there is a bearish fair value gap there. And this is how I'd read the market, right? This is how you can implement higher time frame into lower time frame. And when you're taking profits, like if you're going to hold the trade, then in this fair value gap, I would simply mark out the 0.5 level. That could be a level that you target, or you could target the top range here, but whatever works for you. So let's leave that there, and then we'll play price out, see if it gives us an opportunity to enter. All right. So you can see we've got accumulation, manipulation at the downside. We've tapped just on consequent encroachment here, and then we've immediately retraced back to the upside. Let's play this out. And what this is actually an inversion model. If you have a bit of a look here, so if you go to like a 3 minute time frame or a 5 minute time frame, even on the 3 minute you can see it. See how on this price leg there's a singular bearish gap, right? A big one. If you mark that across in time, we've swept sell side, we've tapped into a PD array, we're delivering from this bullish gap on the 15 minute. We displace and we close past, and then we trade back into it. There's your entry or your long position using an inversion fair value gap. So having an understanding of different PD rays, and what I'd be doing is probably consequent encroachment of that zone. What I'd be doing with different PD rays is I'd be mapping this out, and I'll be using different PD rays to enter, right? Start with one, right? Start with one being like an inversion, something of that nature. And then as you progressively move forward, then you can add different PD rays onto the mix, right? So you can see here now we're progressing kind of into the next day. So if you're going to take partials, I mean, you might have got that tagged into it. It all depends, right? You could have placed your stop loss below this inversion and your 1 to 2 happens fine. So I wouldn't be too concerned with risk to reward, right? Ideally, personally, I like to get at least a 1 to 2, but if only a 1 to 1 permits, like for example, if I entered from here, I'd probably take partials at 1 to 1 and then I'd leave a runner. If the runner didn't hit by 4 o'clock or whenever it was to close the market, then I'll just close the position. I wouldn't want to hold overnight. So now if you speed that up, notice how we've used higher time frame analysis. The next day, we trade into that in the Asian session. And pretty much we just continually step up, right? Remember, you got those relative equal highs here, and there's also relative equal highs here as well. So there's 2 points of liquidity that you expect the market to take out. And now we're progressing into the next session, which is obviously, if you go here, this is the New York session. So you can see we're getting close to New York session, and we come down a little bit. And again, it's the power of three. So again, we've marked out multiple times where the power of three has occurred. Again, this is your accumulation, and you'll start to see this so much now. This is your manipulation to the downside, right? And then this is your distribution move to the upside. So you can see how that kind of works out. You get me? So it's one of those things where the higher time frame, yes, it's important. For me, the 15 minute does the majority of the work, but having a higher time frame analysis allows you to be more confident, like because you know it's bullish, to take a long position here or take a long position here, whatever it might be. Seeing these relative equal highs, seeing that accumulation is another thing as well. So I hope that kind of explains things. A lot of people have been asking for a top-down approach. It's a bit of a longer video, but try this out for yourself. Don't get married to the idea on a higher time frame unless you're holding trades for like hours on end. If you're doing intraday trades and you're doing like 30-minute trades, really just use it as a framework on where you expect price to go and to give you confidence to enter trades as long as you've got your other confluences. So I hope that helps, and I'll talk to you guys next time.